Now that you have an understanding of the technical provisions of the individual mandate, healthcare exchanges, and potential employer penalties, let's take a look at how you would apply this information to develop your compliance strategy. As shown previously, at one end of the spectrum is the play strategy. At the other end of the spectrum is the pay strategy. And the third option is a blended approach. Meet Phil. Phil owns Phil's Marketing Services. Phil has decided to adopt the play strategy in order to comply with new healthcare reform laws. Just keep the status quo, since this seemed to be business as usual and the easiest solution for Phil. Each employee participates in the group medical insurance plan, which has a $12,000 annual premium. Phil's Marketing Services pays $10,000 of the premium, which is tax deductible, and each employee pays $2,000 on a pre-tax basis. Business continues as usual. Phil hears of another option from his friend that owns Janet's Janitorial Services and decides to change his strategy to the pay strategy under healthcare reform. His friend tells him she saved hundreds of thousands of dollars under this approach for her company, which has just over 300 employees. Under this approach, Phil decides to terminate the group health plan and opts to pay the $2,000 penalty for each full-time employee, essentially saving Phil's Marketing Services $8,000 per employee. Phil is very happy he has more money in his pocket. While Phil is very happy with his newfound money, when he walks through Phil's Marketing Services, some of his employees are very unhappy. He sees a resume on the printer, and another employee is online checking out jobs.com. Phil decides to rethink his plan, and the first thing he realizes is that his $8,000 savings isn't really $8,000. Why? Because the $2,000 penalty he pays to Uncle Sam is non-deductible. That means in order to pay the $2,000, Phil's Marketing Services needs to generate about $3,000 in revenues. The $8,000 Phil thought he was saving is really only about $7,000. Phil isn't as happy as he was before. Some of his employees are still unhappy. One has even moved on to another company. Others have gone to look for health coverage at the new state insurance exchange, and several are mad. After talking to Sally, his CFO, Phil decides it may be in his best interest to take the $7,000 savings and give it to his employees to help offset the cost of their coverage through the new state insurance exchange. However, Uncle Sam steps in again and reminds Phil that he needs to pay payroll taxes on the $7,000. Now he is only able to give about $6,300 to each employee. Sally is happy with her $6,300 from Phil, but wait, Uncle Sam wants his income tax, which in Sally's case is 40% because she makes over $200,000 a year. Sally is not as happy because she now only has $3,800 to buy her new coverage at the state exchange. When Sally looks at her premium bill for her coverage through the exchange, it is $12,000. Sally realizes she has $3,800 from Phil's Marketing Services, but her balance due is still $8,200. Now Sally needs $8,200 to cover the cost of her premium. But remember, Uncle Sam's still there. To make the $8,200, Sally will need to earn $13,700 this year. Sally is mad. While walking through Phil's Marketing Services, Sally overhears her administrative assistant, John, describing the money he has saved on his healthcare coverage by going through the state insurance exchange. Sally is confused. Her healthcare coverage through the state insurance exchange cost her a lot of money. She invites John into her office so they can talk about the details of his experience. John explains to Sally that his annual salary is about $30,000. When Phil's Marketing Services decided to pay the penalty and then pay the difference to John, it was taxed at a much lower rate. After Uncle Sam deducted his income tax from the $6,300 payment, John still had about $5,400 to use at the state insurance exchange. John went to the state exchange to purchase coverage for him and his family. The premium was $12,000, the same as Sally. The difference is that at the exchange, John is told that based on his income and family size, he will pay no more than 5% of his income, or $1,500, for his $12,000 premium. Using the $5,400 he received from Phil's marketing services to pay the $1,500 premium cost, John now realizes he has $3,900 he can use to help fund his health savings account. John is happy. So let's recap. Sally was happy when Phil's marketing services chose to play and provide her coverage. It only cost her $2,000 a year pre-tax. Now, because Phil's marketing services has decided to pay the penalty, she has to earn $13,700 to purchase her coverage through the state insurance exchange. Sally is very unhappy. John was unhappy when Phil's marketing services chose to play and provide his coverage because it cost him $2,000. Now, because Phil's marketing services has decided to pay the penalty, it only cost John about $1,500 for coverage. John is very happy. So what is the moral of our story? Something as complex as healthcare reform can make decisions very difficult. What is right for one employer or even one employee may not be right for another employer or another employee. The best solution for a company planning for healthcare reform in 2014 and beyond is to understand how any decision they make, even if it is to continue business as usual, impacts each employee. If it is practical, a business owner may be best served to consider a blended strategy, where employees who can benefit from the play strategy, like Sally, have that option, and people who might benefit from the pay strategy, like John, have that option as well.